um, and look at something we talked about before, which was reversals. And all reversals we talked about before contain one or more of the elements below. And in terms of being able to see these on the dome or on the tape, they go from easy to hard, from 1 to 3. Now, every reversal, the market can't reverse unless one or more of these things happen. Now, it's okay to spot these before or after you enter. So don't look at everything we're going to talk about today as stuff you have to do to get into the market. If you want to put a limit order resting at a price, then put a limit order there. So if you want to go short, if you've got a price above, you want to go short, put your limit order in there. But you want to be able to see these things happen after you get in if you trade that way. Okay? So these are the things that confirm your trade before or after. And basically, absorption is the first, which basically, if your market comes down, everything we'll talk about now today, we're going to talk about short to long, actually, I should have said. Not long to short. Or am I talking about short to long? Okay, yeah. So short to long. So market's going down and it's going to turn up. Okay? So absorption means the market moves down, people still keep selling, but the market stops moving down, which means the bidders are actually staying firm. The bidders are saying, okay, you guys sell to me, you guys sell to me, you guys sell to me, I'll take all you've got. Okay, that's absorption, that's all it is. No need to go into too much more detail. Sellers fading away, fairly simple. You get to a price, sellers stop selling into that price. Okay, it's not very difficult to spot, to be honest. It just can happen quickly, and it can happen very often. Okay, so you'll see the market pause all the time. So if you take this out of context, away from an area that you're actually looking to get into a trade, you're probably going to get stopped out a lot. Okay, so the other thing that's going to happen for reversal is buyers will come in and start buying. Okay, so buyers will actually overpower the sellers. Now that could happen after the absorption. It could happen after the sellers fade away. It could happen after absorption followed by sellers fading away, or it could just happen on its own. I know this is what JP calls the roll. Okay, so if it just happens on its own, it's going to be pretty hard to spot in terms of looking at that to get an entry, because you could be waiting there. Okay, it's coming to my price. Boom, buyers come in and it moves up 6 ticks. Okay, so that's why we say 1 to 3, easy to hard in terms of identifying on the order flow. Okay, so we won't talk too much about that because it's slightly theoretical. But what I do want to talk about, because this is something to bear in mind as you are listening to me today. Okay, we've all entered trades and seen them go offside immediately, and then come back to your entry price and just like tickle around at your entry price, giving you a chance to get out before it then takes a dive. Okay, and that's not something that happens on all markets. So if you look at a market like the US Treasuries, US Treasuries take a long time to turn around, and it's a bit like moving one of those big container ships, right? Once it moves around, it's not going to wiggle its way back. So one of the things about the the ES has got a tendency to give you second chances, okay? And that's second chances to get in, and definitely second chances to get out, because I'm sure everybody has entered a trade at the worst price, seen it come back, just offering you up a chance to get out, not taking it, and then it's just taking a dive on you. Okay? So one of the things about order flow and the ES, being right about the order flow doesn't necessarily mean you're trying to hit into a level at your first suspicion that a turn is occurring, right? So you can, if you see the absorption, you don't have to hit into that straight away, because it's not the kind of market that's just going to shoot off 10 ticks without, coming back and giving you a second chance. And also, being wrong does not necessarily mean getting out at a loss. Okay, there are certain things you're going to see on the order flow. So if you do something like that, you get in at a price and it just moves against you, and then it comes back to you. There's certain things you can look at in the order flow that when it comes back to you, you say, actually, this really looks weak. and I might just take a 1 or 2 or 3 tick loss on this trade instead of holding on a bit longer. Okay, so just keep in mind that we're talking about a market that does give you second chances, and that does affect the way that I use these tools. Okay, so the first one, we're going to look at the dome perspective, and then we're going to look at the tape perspective. Okay, so the absorption on the dome, okay, is just a large quantity of volume trading at or near your level. And by large quantity, you're going to see on your dome, you're going to see how much is trading into each level for that day. Okay, so if you've got a couple of thousand trading into that level, you really want to see 5,000 or 6,000 contracts trading around your level. Okay, it won't, obviously it won't be to the tick. I mean, it often is with the ES. It won't always be to the tick. Sometimes you'll see a lot of volume trade, and then it will move through that price. But as it moves through, the volume drops drastically. Okay, so sometimes you'll see the absorption. You can hit into the absorption straight away, but sometimes it's good to let it play out a little bit. So basically, market will often move through after the absorption, and also it will often move through your level, come back, and then you'll see the absorption occur when it comes back. Okay, now the other thing is the market is often going to pull back to the level where the absorption occurred. Now that kind of might be a bit of an odd thing to say. Why would it come back there? Well, maybe another way to look at it is if you have that absorption near the low, okay, and you do actually reverse. So you're looking at short to long. You have the absorption near the low. It moves up 3 or 4 ticks. When it comes back, that area where you had that absorption will be the thing that stops you getting a double bottom. Okay, the reason that it won't actually go down to the lows again to retest the lows is because of the amount of volume that trades is at that level. Okay, so I'm gonna say we don't need to go into the theory of why too much, but that will actually stop the market. Okay, so in terms of what's aggressive, well, an aggressive trade is that when you see the absorption, then you hit into it. Okay, so the moment you see that 5,000 or 6,000 contracts, you hit into it. I would say if you're going to do that, you really want to be scaling out some 3 or 4 ticks, because quite often you'll get that absorption, you will get an initial reaction, and then it will move straight down. Okay, and all you're doing basically is you're taking a more aggressive trade. You're getting in just because you see that amount of contracts trade. You're not watching the next part of the story. You're not letting it play out a little bit more to see, okay, is it really showing another sign it's going to hold? You're getting in at the first sign. So if the market prints volume, in terms of less aggressive, if you get the absorption printing the volume, then it pops down to 2 to 4 ticks, and you see that, I might print the 6,000, then 3,000, 2,300. That's a much stronger sign, and actually a place you can get in at a better price, because as you see the sellers kind of fade away as you go down 2 to 4 ticks, you've got some kind of added fuel to your fire. Now, if the market prints the volume and pushes straight up from there, okay, you may well have missed the trade, but you wait for it to actually come back to that level and retest it. And the other thing you're going to see is what will very often happen is when you get these reversals, obviously if you print volume, it'll come back to the area. It shouldn't be able to get through it. Now what will happen quite often is you'll go to a low, you'll get the absorption, you'll go up 4 or 5 ticks, you'll get another level where you trade 3,000 or 4,000 contracts, 5,000 contracts, right? If that happens, it's not going to come down to the original absorption point. It's not going to come down to the original reversal point. What you've got to look at is the potential that it's actually going to come back down to that second area of high volume and not get passed through there. Okay, and we're going to look at the dome in a second, but we will just look at the tape, the things that we're going to look at on the tape as well before we look at the dome for absorption. Okay, so in terms of the tape can mean a number of things. Traditionally, tape means time and sales, which for Jigsaw would be the reconstructed tape. The tape could also mean that current trade column in the middle of the depth and sales, the one I said that, you know, if you're just starting, that should be your focus, because that is showing the time and sales information. And the tape could also be the leftmost strength meter or power meter that's showing you the actual sell orders against buy orders. It doesn't really matter which one you're looking at because they're showing the same information. Okay, so one of the problems with absorption, and the reason if you fade every absorption, is because there's a lot of correlated markets with the ES and there's a lot of arbitrage going on. So quite often when you see absorption, you could be looking at one half of a stat arb trade, which is just somebody, you know, maybe they're selling the futures and buying a basket of stocks. And if they're doing that, they really don't care about which direction the market goes in after they get in. So there's no concept of them being trapped. Okay, so their trades, that trading that they've done there, doesn't really have any directional impact after after they did get into the trade. Obviously, they are going to unwind the trade, but they might unwind it below or above, and you know they might buy, unwind below, and still be making a profit because it's an arbitrage trade. Okay, if you see the absorption at the low, you want to let the sellers burn themselves out. So if you see 5,000 or 6,000 contracts trading, but the sellers are hitting it, and it's really rapid trading, there's no reason to buy into that. You really want to see those sellers burn themselves out. And one of the reasons is a lot of other people are waiting for those sellers to burn themselves out, and it's like wolves smelling blood. You know, as soon as they smell blood, as soon as they think the sellers have burnt themselves out, there's other guys that will buy into that, knowing that those sellers are actually trapped at that low. Okay, so you need to let them burn themselves out a little bit, because if you don't wait for them to burn themselves out and they keep hitting it, they will go through the level. So even though a bidder steps up 5,000 or 6,000 contracts, absorbs 5,000 or 6,000 contracts, there's two possibilities. One, it could be a stat arb trade. Two, he could be getting his pants pulled down. You know, he could be a losing trader. Just because somebody absorbs 6,000 contracts does not mean he's going to be successful. So you wait for the sellers to fade away, because if they keep selling, they will burn through. Okay. And the other thing you don't want to see large sell market orders trading into it. Okay, so when you see the absorption, it's really not good to see like 1,200, 900 lot orders sell into that low if you're about to buy it. Now the exception there is that those large orders, when you see the 1,000 lot orders go in, they quite often get stuck. Okay, so when you see the 1,000 lot trade hit in, and then you see that the market can't tick down, okay, that's a really positive thing to see somebody throw 1,000 sell market order in and price ticks down one tick and then ticks back up, because it means that guy's trapped. Right, now he could be an arb trader as well, but you know, you have to try and build a bigger picture. You can't, you know, you got to try and you know, put faith in something, so to speak. So basically, if you see absorption and you see some large orders coming in, again, it's a sign that says give it a little bit of time, give those guys time to sweat a bit. So if you see like 1,000 lot order, a 900 lot order, an 800 lot order sell in, give them a minute, and if it still doesn't tick down after a minute, those guys are going to be sweating, right?